Today we're going to take a look at bond markets. We're going to have a general overview of the topic. This is a session that's actually something that we should be covering in an entire course. So today we're just going to have a quick introduction and take a look at the implications for portfolio management. So today we're going to have a look at a general introduction to bond markets. We'll also take a look at some of the differences between the world's major bond markets. We'll take a look at how international bond markets work, how emerging markets work. We'll have a quick introduction to something called Brady bonds. We'll see how bonds are quoted. We'll get a very, very brief introduction to what duration means in terms of bonds. Some of the sources of risk and return, some of the types of bond management, and some types of structured notes, in particular floating rate notes. The bond market is surprisingly large, especially people who've looked at equity markets will be very surprised to understand or surprised to realize that bond markets are actually larger than the world's equity markets. Yet we don't hear nearly as much about bond markets as we do about those equity markets. Total market capitalization for equity markets is roughly in the area of $60 to $70 trillion. World bond markets at the moment exceed $100 trillion in size. And we see that the market for corporates is only about $20 trillion of that $100 trillion. The remainder is the market for government bonds and near government type bonds. We should also be aware that the size of total world borrowing is about 3 times that of equity. And that's because the market for borrowing includes the non-tradable borrowing, the debt of corporations that is held by banks. The relative share of each currency market depends not only on the size of the bonds issued within that market, but also the spot rate for bonds. So the proportion of the debt within the European market, the American market, Chinese, Japanese, and so on, is going to be a function of the actual traded value of the bonds in that market, but also the currency movements. We see from this report from Standard & Poor's that the markets in the last few months have been very much in flux, and that global markets have increased substantially over the past year to a total value of about $21 trillion as of April of this year. That's largely because of the low cost of debt and also the strategic advantage for companies of raising debt financing, in some cases to replace some of the equity as we've moved through such turbulent times. Companies have recapitalized using debt because debt is essentially very cheap in today's market. We've also seen that several major players have seen substantial credit downgrades in the first part of 2020. And as a result, the value of those companies have seen their debt fallen by over $3 trillion. Since the beginning of 2019, total corporate debt has increased by about 10%. Again, because of the relatively low cost of debt, and that many companies have thought this is a really good time to go back to the market and reprice existing debt, but also to replace some of their equity with additional debt. Global bond markets are made up of several different types of debt. And that includes things like straight debt, basically the ordinary corporate or government bonds that include coupons, and zero coupon bonds. And taking a look at these numbers, a little bit out of date, they're from our textbook. This shows us that the amount of global debt in dollar terms, US dollar terms, from 2012, for example, about $27 trillion of total debt existed at that time, and about 80% of that was straight corporate debt. The floating rate debt or floating rate notes represents debt instruments that have variable coupon rates that are established by some kind of a benchmark interest rate most commonly something like LIBOR, the London Interbank Offered Rate, something we'll talk about a little bit later. We also have things like convertible debt. That means debt that can be converted to equity under certain conditions at a certain point in time. And warrants. Warrants are a little bit different from convertible debt because they're essentially a coupon that is attached to debt that allows for the bearer to buy shares in the equity market at a fixed price at a point in time or over a period of time. So warrants are essentially an equity bonus, or sometimes we say an equity kicker, that provides an equity type return to bondholders. This means that we have a total market that's made up of mostly ordinary debt, but we need to be aware of some of these other types of debt instruments. And we'll talk about floating rate notes and structured notes a little bit later on in this session. When we take a look at the bonds that have been issued on a global basis, include bonds that are issued in US dollar, in euros, in pounds, yen, francs, Canadian dollars, and many other currencies. Although predominantly the most important currency for issuing bonds has historically been the US dollar, we see the euro has become at least as important, and certainly in more recent years. Pound-denominated notes have also been important and continue to be important. The yen, the franc, the Canadian dollar, and increasingly other currencies like the rupee and the renminbi are becoming important in terms of issuing foreign-denominated instruments. The same $27 trillion in debt that we saw in the previous slide is split about 50-50 between US dollars and bonds, with the representation of a few percent for those other currencies I mentioned. The major types of debt issues that are used include things like, well, as we saw earlier, those straight bonds, or vanilla bonds they're sometimes called, with a fixed coupon. Floating rate notes or variable rate bonds are second, and then we have bonds with convertible features or warrant features as well. Now we have the euro as the major currency of issue, followed by the dollar. To keep track of our performance, we use things like bond indices. We're all familiar with using things like the Standard & Poor's 500 index, or perhaps the Dow Jones index, as an indicator of our success. If we're doing well, it's even better when we're doing better than the Standard & Poor's index. Same thing with bond indices, although they're harder to find and they're harder to compile. Essentially, a bond index is an index that's calculated based on the assessment of the movement of the bond market as reported by bond dealers. We can't directly observe the bond market the way we can the stock market. We see that there are also going to be price indexes as well as total return indices, and essentially a total return indices is based on the coupon payments as well as changes in price. Some of the indexes that I'm familiar with, or indices that I'm familiar with, include things like the DEX index. And here we can see an exchange-traded fund that's based on the reported movements in the DEX index. And so essentially it's a corporate bond index that is replicated by this particular company by directly buying shares and where they're available. That's not always possible because bonds are not as liquid as stocks. Some bond issues are not available to purchase, and so the fund manager here has to try to replicate the movements in the corporate bond index by buying available bonds. In a bond index like this one, you can see that the yield can be tracked over time. And so over a short period that we're looking at in the top left-hand corner of this particular chart, we have the prices moving in inverse direction usually. So we have the yield goes down, that means the bond price has gone up, and then when the bond yield goes up, it means the price has gone down. And over this period of time, it appears that the price of bonds has risen as the yield has decreased. We can also see a measure of duration. Now, duration tells us about the expected maturity of that particular bond adjusted for coupon payments. We'll talk a little bit more about duration in a few minutes. And so essentially we see that the duration or the average maturity of bonds has moved between about 5.8% and as low as 5.5%. So over the last while, investors have been lengthening their investments. They're going longer in their bonds. The maturities are extending. And all of that information is reflected in the overall price. And that we see in the total return measures in the bottom table. So the price of a bond issued perhaps at 1,000 has risen from being in the high 900s up to about 1040 over that period of time. Yields fall, prices tend to increase. Bond trading is not done the same way as trading in equities. And as well, we don't have one single type of world bond market. We essentially have several different types of bond markets and many individual bond markets, some of which are managed by only one or two market makers. The domestic markets vary from country to country, and essentially that's where a company raises money in its home market, in its home currency. And of course, that we describe as the domestic market. Yet that is still going to be one of the largest markets in the world when we're talking about the United States, where in the US market we have many different bond market makers, allowing companies from all over the world to raise funds, but denominated in US dollars. You can also raise money in other markets. If you're a Canadian issuer and you want to raise money outside of Canada, that's of course going to be possible. You can raise money in Japan or in the United States or even in China. And if you're a foreign firm, you can raise money in Canada. If a Canadian company raises money in Europe, well, that's still called a euro bond. And if an American company raises money outside the United States, that's also described as a euro-dollar bond. If we have a Chinese company decides to raise money in Canada, well, that's actually called a maple bond. If we have a German company that wants to raise money outside of Germany, perhaps in Holland, that would be called a Rembrandt. Or if it wants to raise money in the United States, it could be called a Yankee. All kinds of interesting names. We'll come back to that in just a minute. And then we have international bonds, and essentially those are bonds that are raising money in several jurisdictions simultaneously, in several different currencies, perhaps because they want to diversify their foreign exchange exposure, but perhaps also because the local market is too small to absorb a large issue without actually creating some kind of a liquidity problem. Sometimes it's just too much money and there are too few purchasers. Looking at these one at a time, essentially a domestic bond is one issued locally by a domestic borrower and denominated in local currency. That's typically the bulk of national bond markets, and the largest issuers are typically governments at every level. Federal governments, state or provincial governments, municipal governments. But also we have those quasi-governmental organizations like the Canada Mortgage and Housing Corporation, for example, in Canada, or in the United States, the Federal National Mortgage Association, or Fannie Mae. Other great organizations in the United States like Freddie Mac and Sallie Mae, Ginnie Mae, that are essentially backed by government and borrow at the risk-free rate. And they're constantly raising money because they're using the funds raised to be able to create liquidity in mortgage markets or even student loan markets. Now, the global market includes foreign bond markets, where bonds are issued on the local market by a foreign borrower denominated in the local currency. Essentially, the trading happens within the local market, but the key thing is that it allows for foreign issuers to be able to participate in overseas markets. If a Chinese company wanted to raise funds in Canada, it would be regulated within our system by the Department of Finance. And the funds that would be raised in Canadian dollar and would be a future obligation that the Chinese firm would have to manage. In that case, it would be called a maple bond. If a company raises money in the United States, those are called Yankee bonds, Rembrandt bonds in the Netherlands, Samurais for bonds that are denominated in yen and raised in Japan, and so on. In fact, we see some of the world's fastest growing markets are those for bonds like panda bonds, which are bonds denominated in renminbi. Perhaps an American company wants to do business in China, wants to build factories and build up a retail chain, needs money to invest for the long term, and wants to hedge its foreign exchange exposure so that later on when it earns money that is denominated in local currency in yuan or renminbi, it will use the proceeds of its Chinese operations to pay off the borrowing that it's made in China, denominated in local currency. So those are some examples. Now the panda market was impossible because foreign borrowing was restricted in the early days, and so some of the first borrowing that was denominated in renminbi were called dim sum, and those were actually issued in Hong Kong but denominated in yuan. And so that was the fastest growing bond market until China started to liberalize its overseas borrowing. And in fact, one of the earliest issuers, one of the biggest issuers of yuan denominated instruments was the province of British Columbia, who went to market in Hong Kong, raising money denominated in renminbi, with a bond issue, I think, of a total value of about $80 million. So it allowed Chinese investors to invest in Canadian markets, essentially, by investing in a Canadian company. The risk was largely based on the activity of the province of British Columbia, and gave people essentially a foothold in Canada without actually having to come here. Now, we can see that many companies will come to other countries. In fact, when a company like Walt Disney wants to raise money in Canada, it can do that taking on Canadian dollar risk. You probably say, well, why is it doing that? It hasn't got any Canadian operations. It hasn't got Canadian theme parks. However, companies will do this in order to diversify their own exposure and perhaps to participate in some kind of risk arbitrage. So it's not always about hedging, although that would be the original idea. We also see there is an international bond market where companies can raise funds simultaneously in multiple countries. Essentially, these tend to be regarded as euro bonds because they're denominated in a foreign currency. So euro bonds is generic catch-all for all bonds denominated in any currency outside of the home market. Many of the euro bonds are listed on the Luxembourg Stock Exchange in order to create some kind of a home jurisdiction where they're quoted at least once a year, perhaps once a quarter. Originally developed in the 1960s, it was seen as being a very low-cost and efficient way to raise a lot of money without having to deal with exhaustive regulation. An example of that, here we have what we call a tombstone. And essentially, it's an advertisement in financial publications that's provided as an advertisement for the issuers. It's basically the place where you go to brag about what a big deal that you just did. In this case, the financial instrument is issued by Japanese steelmaker NKK, and it's rather a complicated instrument. It's called a dual currency bond in yen and US dollars. This particular bond is for an issue value of 20 billion yen. Which will be redeemed as $110 million. And the issuers, the issuer is NKK, but the underwriting was led by banks like Nomura, Mitsubishi, Prudential, Yamichi, Bankers Trust, and so on. So this was the syndicate that put together the deal, and they will market it to their clients. They've taken on an undertaking to sell the entirety of this $100 million bond issue through the underwriters. So here we have a list of those underwriters. And as I say, essentially this is an advertisement for those firms. Main characteristics of the international bond market. Well, first off, a lead underwriter approaches their friends, all the other international banks, and says, hey, you remember that I helped you to do this deal? Well, I'd like you to help me do a deal. I've got a $100 million issue. Would you take $10 million? And so by ringing around to their friends, essentially the syndicate is created. The underwriting syndicate led by the lead underwriter, the book runner sometimes they're called, will go to other banks in different parts of the world and put together an underwriting syndicate. The banks will use their subsidiaries that are based in one of the money centers in the world, probably London, and one with both a good tax law, well understood tax situation, and some kind of a legal system that provides a reasonably safe foundation for contracting. The corporate borrowers use a subsidiary incorporated in a country with favorable tax and regulatory treatment. Coupon payments, usually annual, in order to simplify the underwriting. And they're sold in several different stages, or we say tranches, slices. The process starts off by creating a syndicate, which will then be organized with one bank identified as, or usually one bank, not always, identified as the lead manager. It will take about 5 or 6 weeks to create the issue from the origination right through until the deal closing, or financial closing as they sometimes say. 2 weeks for the discussion between the lead managers and the borrower. Announcement of the bond issue with a couple of weeks of notice. On the offering day, 2 weeks from the final placement, final terms will be announced, and on the closing day, the lead underwriter is going to pay the client for the bonds. So the $100 million, let's say, will then be dispersed to the client, and after the closing day, the bonds will be publicly traded. The underwriters will have pre-sold probably more than 100% of the entire issue to their best clients, who can then resell them, hopefully at a premium. So we can see an example of that timetable for our issue. We'll make the decision to issue the bond perhaps 5 or 6 weeks beforehand. Announcement of the bond issue a couple weeks before the initial offer. The offering will be provided with the final terms, and then after a 2-week official notice period, the selling group is going to disperse the funds, and then the next day the funds trade in international markets, in an international dealer market. So the overall process of issuing bonds, the dealers create an around-the-clock market, 24 hours a day, essentially 7 days a week, broker to broker, and regulated, or perhaps not regulated, but managed by an international capital market association. Clearing is established through a privately incorporated company, Euroclear or Clearstream, and that provides the financial closure over usually a 3-day period. So on the day in which the bonds are sold, 3 days later the cash is dispersed to the seller of the bonds. They get a transaction fee for every transaction that they manage, and a custody fee on an annual basis for holding on to and recording the transactions. For emerging markets, there are several alternatives available for domestic bonds. There's a possibility of trading within the country, although there are going to be problems with often liquidity. In other words, there just aren't enough buyers in order to be able to complete every transaction as quickly as you'd like to see. Then there are also going to be the opportunity to sell in foreign markets, as we saw earlier, exactly as we saw earlier. International bonds, which can be issued in many markets, which is typically necessary for large transactions, like, for example, when a telecommunications company decides to go public. Brady bonds were something that was developed as a result of emerging market crises that we saw in the 1990s, and so mostly led by the United States. Something called the Brady bond. The Brady plan was established to allow emerging markets to convert non-performing debt, steeply discounted, into something called Brady bonds. Basically, these were a solution to the debt crisis of the 1980s, including the ruble crisis and Argentinian and Brazilian debt crises. It allows countries to manage debt which was considered to be otherwise unmanageable by converting the debt in default to tradable Brady bonds, usually with some kind of collateral attached to those bonds. But 20 countries have issued Brady bonds, and the total market capital market capitalization of Brady bonds in circulation is close to $100 billion US. And there are several major differences between bond markets. Among these are the way that the bond prices and returns are quoted. For bond prices, quotations are described as being either a clean price or being the full price. Clean price is going to be the price net of accrued interest, because the bond quotations aren't always going to be on the day on which the interest is calculated. So bonds quoted as clean price are net of accrued interest. The full price, or the full value of a bond, is the sum of its clean price plus any interest that's been accrued since the last payment. So the price is equal to the full price quotation plus accrued interest. Accrued interest is equal to the coupon rate times the number of days since the last coupon date, divided by the number of days in the coupon period. Or an example probably helps understand that better. Here, if we have the clean price of a euro bond quoted at 96%, Q is equal to 96. The coupon rate is 5%, and we're actually 4 months past the coupon payment. So what is the full price of the bond? Well, the price is equal to the quoted price plus accrued interest. 96 was the quoted price. We're 120 days into the period, 360 days in the full period, in our full year, and the coupon rate is 5%. So 120 divided by 60, 33% of our period. 5% times 33 plus 96 is equal to 97.67. So that becomes the full price. There are a number of conventions that are actually different from one market to another, and it's important to basically recognize that. And of course, if we were going to be investing in these markets, we'd be checking and double checking. Our normal convention, the day count convention that we use in countries like the United States, Germany, Scandinavia, is 30 and 360. That means there are 30 days assumed in every month and 360 days in each year. Logically, then 120 days in a quarter, regardless of the actual numbers of days. But for some markets, like those used for municipal bonds, corporate bonds, and foreign bonds, we use that convention. For treasury bonds, it's the actual number of days in the year. So it could be 365, it could be 366. So that convention, the actual means that we take a look at the actual number of days in that period and 365 or 366 days in the year. Or to summarize that, we have a table like this one, and I won't go over these one at a time, but for example, in the United States, we'd say 360 days in a year, 30 days in a month would be the usual frequency. For treasuries, actual and actual. For Canada, actual and 365. Different for Australia, different for Switzerland, UK, and so on. So we'd have to be aware of the differences between national markets. Oh, and just sort of to point out as well, international bonds, we said 30 and 360. Things like floating rate notes, which we'll talk about later, we would use something like actual and 360, which is a little bit different than for bonds. Some of the major difference between bond markets, well, yield to maturity that we calculate is, well, we saw in an earlier course that it's the average promised yield over the life of the bond. And it's the convention that we use across markets may be a little bit different. In the US, yield to maturity is calculated using the semi-annual rate, and we multiply it by 2 to get the annual rate. Most Europeans calculate an annual actuarial yield to maturity, and the simple interest approach is used in Japan. There may also be other differences, including things like legal basis. The legal system is going to be very different from one traditional area to another. For example, European markets typically use either the French version of Napoleonic law or the German interpretation of that, the German Commercial Code. In the United States, in Britain, we tend to use common law. So that the legal form may be a little bit different. In Eurobond case, we use things like bearer form. The bearer of the bond is assumed to be the legal owner. So in the United States, we much more likely have a registered form where the owner is registered in the issuer's books, and that information is held by a legal custodian, usually one of the larger banks. The registration form allows for easier transfer of interest payments, provides a standard registry that's available to the company, and it makes it easier to calculate the amortization of the principal value. As always, taxes are a major consideration. One of the reasons why the Eurobond market developed in the first place was to create an offshore opportunity for investment so that taxation wouldn't occur in the country in which you made your investment, but later on the taxation could occur as the money was brought back onshore. So taxation is an important part of why we have international financial markets. Another reason why people invest in countries like Luxembourg, for example, is that rules have been established in those markets to ensure that there is no, or at least very small amount of taxation that happens in the market in which the transaction is deemed to occur. Another factor that's an important part of what we see in international markets is the information that's reported in the yield curve that we've looked at before. And essentially, if you recall, our yield curve is an estimate of the time or term structure of our interest rates. The yield curve needs to report on stocks that are essentially homogeneous in nature, rather bonds that are homogeneous in nature. And the only difference, therefore, is the maturity. And to make sure that happens also, we assume that the yield curve is made up of bonds that are trading at par. Our simple example of a yield curve typically looks like this, where we have a relatively steep yield curve in the shorter time periods, for less than a year, for 1 to 2 years, for 2 to 3 years. Typically, not only is the curve upward sloping, but it's relatively steep at the very beginning, flattening out in later periods. That's not what we're seeing right now when we look at the market today. Essentially, interest rates are very low for the short term because of the poor state of the economy, but also bond investors expect that that's going to carry on for a relatively long period of time, and so we can see that the yield curve is not steepward upward sloping in the early periods, and it doesn't appear to gain much until we get to 10 years or 20 years into the future. So short period yield curves look very flat in general. Now, when we're looking at a multi-currency version of this, or looking at international comparison of yield curves, it's important to remember the relationship of currency to interest rates. Essentially, we'd say that the difference in the interest rates from one market to another, as we saw in last week's sessions, were the differences in monetary and fiscal policies of the home countries, but especially the effect of inflation. And when we're trying to understand the difference between the forward and the spot rate for any currency, we have to remember that it's the difference in the interest rates. So in the formula that we see here, essentially would say that the forward rate for any currency is going to depend on the spot rate today, plus the difference in the interest rates for one country versus another. So if we're comparing, for example, the yen to the dollar, it would be the difference in that currency that would define that differential. If we had a relatively small interest rates, for example, in Japan, if we had say 0.4% as the interest rate today, and 4.5% in the United States, then that difference would essentially indicate that today's spot rate would represent a smaller forward rate, a value of less than 1 in this ratio. And so we'd expect to see the yen appreciate against the dollar. So by comparing the yield curve in two different currencies for each period of time, for the forward rates for each period of time, we can derive the term structure for the forward rates for each time period, and therefore be able to predict what's going to happen to the currency in the future. If you take this example from the textbook, you can see that the rate for Japanese bonds has typically been in the past, and even today is still much lower in Japan than it is in some of these other countries. For the Eurozone, for the United States here at the top, and for the pound here at the top, and the US economy here in the middle. And so we would expect that low interest rates would predict a depreciation of the currencies with the higher ones because of inflation. And you remember, of course, interest rate parity. And so that also is built into the difference in those bond markets. Credit spreads are part of that, regardless of whether it's domestic or international. And remember that the yield for any type of bond, except for government bonds, is going to reflect a credit spread, a credit differential. And so we take information that we get from bond rating agencies like Moody's, Standard & Poor's, Fitch, ICB, and use those to evaluate the relative credit worthiness of different types of business. Our credit spread, or the default risk premium, essentially includes a probability of default, a premium for credit risk, and perhaps also it's going to capture some of the liquidity effects of having a less traded bond. Credit spreads are essentially used to create parallel yield curves for each successive lower level of risk. And those lower levels of risk also are indicative of the probability of the company's bond being downgraded over a period of time. For example, during the next year, what is the chance of a downgrade? You can see that from the historical experience. And for example, in this table from Moody's, you can see that for a bond that's currently rated at triple B, what is the chance that at the end of the year, at the end of 1 year, it's still going to be triple B? Based on the historical patterns of default, you can see that there's an 84% chance that a triple B will stay a triple B. There's about a 5% chance that it'll be upgraded, and there's about a 6% chance that it'll be downgraded, based on the experience of perhaps the last 20 years of ratings done by that agency. And so from this table, you can see essentially, the company that starts the year as a AAA has a 90% chance that it's going to remain a AAA. There's a chance with a AA, with an initial rating of AA, there's about an 88% chance that they're going to remain AA. And they could go up and they could go down according to this table. So there is a chance of default for any business. Even AAA businesses are theoretically capable of defaulting, but a AAA business, the chance of it defaulting are pretty close to zero. A AA, still pretty close to zero. By the time you get into the double Bs, there's still a pretty small chance of going to zero. But if you're an investor in the bond, you don't want it to be downgraded even one step, because that will decrease the value because of the increase in the credit spread. So you're carefully looking at and trying to understand what's going to happen to your bond because of default risk. The the difference in those credit spreads tends to also vary with the state of the economy. Here we have a table that shows the credit premium, for example, for a AAA company. The red line essentially tells you that the spread between the risk-free rate and the rate that you would earn on a AAA company in a normal year is something between 0 and 1%. But if we have a particularly tough time, like when the economic crisis hit 2008, 2009, that default risk premium or the credit spread can double. And if you're a lower rated bond, for example, triple B, perhaps it can go from being in the 1.5 range to 5%. It can more than triple. So we also need to be aware that there is a fundamental nature to credit, whether it's international or domestic. Now, having said all of that, we can start to understand the nature of the return to foreign investments, to foreign bonds in particular. There are 3 principal components to returns on foreign bonds. While you hold on to the investment, there's going to be the interest that you receive, the coupon payment or the yield. There's also going to be the capital appreciation that you're going to receive in foreign currency terms. So if your bond goes up by 1,000 yen over the period, that's going to be appreciation in local currency. And then there's going to be the currency movement, either in favor of or against that value. So that's the third part. So our total return then is equal to yield minus some kind of measure of duration times the foreign yield, or times the change in the foreign yield as a result of interest rate changes, plus any kind of a movement in currency. The risk on foreign investments as compared to the return, it essentially comes from 2 sources, interest rate risk and currency risk. Now, there may also be some market risk. There could also be some credit risk, but the 2 sources that are unique to international will be the interest and the currency. Credit risk needs to be taken into account for everybody, but not so much for government bonds. Now, one of the other things that portfolio managers may take into consideration is that many of the risks that are connected to one or more of these risk factors can be partly or perhaps even wholly hedged. When we talk about currency hedging strategies, essentially we're keeping in mind that foreign investments can be hedged against currency risk by using forward contracts. We can sell forward currency contracts in the opposite currency in an equal amount, or at least a partial amount, to the principal value that's at risk in the bonds, hedging or insulating the company against the risk that is inherent in that particular instrument. The decision whether or not to hedge depends on return and the type of risk that you have. Hedging may turn out to improve the return on a foreign bond if the percentage currency movement is less than the cash rate differential, the difference between the domestic and the foreign rate. Otherwise, it wouldn't make sense to hedge. We'll talk a little bit more about hedging later on in this course. The general idea in an international portfolio is that we should look at several different stages of our portfolio strategy. First off, find the right benchmark. If we're using an international bond benchmark or a domestic bond benchmark, we need to keep in mind that we have got a representative benchmark. That means that the market capitalization weights may be very different, and we need to keep those in line with the relative size of the different markets. When we're looking at the selection stage, you can start to take a look at the risk that will come as a result of currency that could evolve because of differences in monetary and fiscal policy, difference in public spending, the size of a country's deficit, the balance of payments, whether or not the company has been able to maintain a balance of trade, perhaps different inflationary pressures from one market to another, and politics and business cycles may not perfectly align between the different markets. Some of the other factors that may be part of our overall strategy is to choose the right sectors to get the right kind of credit. For example, buying bonds may mean buying government bonds, which would be very different from certain types of corporate bonds. Mortgage-backed securities as well may be another alternative. Are we going to go into corporate bonds? Are we going to go into lower quality, high yield bonds? Inflation index bonds? Emerging market bonds. So which sectors are we going to choose? Then we have to look at the duration and perhaps how much interest rate risk are we going to bear. By choosing long duration, we're taking on much more interest rate risk. If we have bonds that are going to renew on a regular basis, on a monthly or quarterly or annual basis, we have less interest rate risk. There may be other things that we're going to do to improve our risk. We can perhaps look at things like laddering and barbells and do that to try to increase return while keeping risk under control. We also need to be aware that there's different amount of volatility in our currency for different markets, and vice versa for a company operating in a foreign country looking at ours. For example, here if we have the bond market represented in the United States, Germany, the United Kingdom, and Japan, if you're taking a look at the United States in its local, its local currency, US dollars, it has about a 4% degree of volatility. Germany, in German currency, in euro, in about 3.7, in the United Kingdom in pounds 5.4, and Japan 4.2. Not a lot of difference. But if you're an American investor investing in dollars in another country other than the United States, you can see that volatility is much greater because you have the combined effect of the volatility of the underlying investments plus currency. A U.S. investment in Germany in euros could have a volatility of 10.4. In the United Kingdom, 9.3. In Japan, 12.9. Or if you're looking at a German investor who's investing in euros in the United States, a correspondingly equal, well, similar anyway, level of volatility, 10.6 in the United States, 9.3 in pounds in the United Kingdom, and 12.5 in Japan. So overall, we could say, thinking about our international portfolio strategies, our investment strategy is based on our view of the world. What is our scenario for the next month, the next year, the next decade? What do we think is going to happen to different levels of interest rates? What's going to happen to currencies? And what's going to happen to the quality of the pool of available investments? Some of the inputs to our strategy then would be things like what would happen to the yield curve for government bonds in each currency, for the risk-free or default-free yield curve for each of the currencies. What will happen to quality spreads for the type of investments that we're looking at for that portfolio, and also what will happen to exchange rates. Now, so far in this session, we've been looking at bonds, and bonds are, by their nature, long-term instruments, even though you can buy a bond which may have a 10-year maturity, but the bond will actually mature next month. So by their nature, by definition, they're long-term. We can actually invest in other financial instruments that are renewed on a regular basis or perhaps created for a short-term purpose. Those tend to be short-term notes rather than bonds. And in the next part, we're going to take a look at certain specialized instruments that include those short-term notes and some notes that are also going to have special features, special types of optionality that are built into them. So things like structured notes, also things like floating rate notes. Essentially, a structured note is a bond or a short-term note with some kind of an option-like clause built in. Typically, they're issued by financial institutions, and only the financial institutions with the most solid standing. Now, that sometimes means that we're talking about companies like auto manufacturers who have very large financing divisions, or large engineering companies perhaps that have large financial services divisions that operate mostly like banks anyway. They can be bought and sold. They're rated like investment grade bonds by the rating agencies, and they're sold to institutional investors principally. They may offer long-term options that are not publicly traded, and they're typically designed for specific types of investors who are willing to take a bet on things like interest rates or currencies. The insurer will usually hedge the usual risks of the structured note and end up with what is essentially going to be a plain ordinary bond. at a relatively low cost. Also treated like euro bonds, euro-dollar investments, they do not have domestic regulation or domestic taxation. Now, floating rate notes, or FRNs, are a big part of the international bond market, and they're a large part of the structured note business. They represent about a quarter of all of the euro bonds that have been issued. And many of the issues are in euros or dollars. Those are the ones that are the most dominant. Major issuers, again, are financial institutions. They're typically indexed to a particular measurement of interest. The interbank offer rate, such as LIBOR, and if it's the central bank, European Central Bank's interbank offer rate, it's called Euribor, and that's quoted in euros. The coupon rate for floating rate notes is generally reset every quarter. So they will take the quoted rate and they'll reprice it or reset it on a quarterly basis. And they have coupons that adjust to those floating rates, those rates that are going to be repriced. So the coupons will change along with the interest rate movements of that underlying index, LIBOR, for example. Here we have an example. We've got a company with an A credit rating. They have created a bond called a perpetual bond, sometimes called a perp and sometimes also called a gilt, because of the gilt edges that they were sometimes produced with. This is a bond that never expires. In fact, it will continue to circulate until the company buys them back, which it would do if the interest rates were to fall substantially. Here, the coupon is set at 6% set at LIBOR plus a spread of 30 basis points, 0.3%. Sometimes later, LIBOR is 6%. But the market requires a spread, because of the credit risk premium, of 60 basis points, or 0.6%, for a corporation like this one. If we want to get an estimate of the bond value on the date on which the value is set, the rest date, using the freezing method, here we would start off by saying that the value of the coupon in a normal situation before any kind of change is 6% plus 30 basis points, or 6.3%. The yield that's required by the market now has gone up to 60 basis points, so R is equal to 6% plus 60 basis points, or 6.6. The price that we would receive for a bond that was normally priced at 100 would then fall from 100 to 95.46, and we get that by taking the coupon rate at the beginning over the rest rate at 6.6. And that says that essentially our bond is worth 95% of what it was before. Now, that's how a floating rate bond pricing would be set. Essentially, floating rate notes are very popular. As I mentioned, about 0.25% of euro bond notes in circulation. They tend to be relatively stable relative to straight bonds because of the ability to adjust with changes in both the interest rates because of LIBOR, but also the credit spread because of that premium. One of the main motivations to invest in floating rate notes is to avoid interest rate risk, although there are special cases where you can actually use these as an interest instrument to express a belief that interest rates are going to rise or fall. By the way, another word for floating rate notes is floater. And in this case, a bull floater essentially is going to be set up so that it will benefit investors if interest rate drop. If we have a bull FRN, also known as a reverse floater, it's set at a fixed rate minus LIBOR. And a bear FRN benefits benefits investors if the interest rates rise, and that would be an FRN floater with at a fixed rate plus LIBOR. Now, another type of specialized structured instrument is a collateralized debt obligation, sometimes called a collateralized bond obligation, a CDO or a CBO. And this is a type of structured note that allows structuring the credit risk that you would assume with a portfolio of bonds. Essentially what happens is a bank will take all of these debt obligations, just a fancy way of saying bonds, and we'll bundle them together into a special purpose vehicle. We'll have bonds from a very similar set of companies. For example, short-term financing that's provided by car companies to people who are buying cars. That can be a set of those obligations. Works a lot like a mortgage-backed security in that respect. So it can be for any class of debt. As long as we have the documentation to call it a standardized debt obligation. This special purpose vehicle essentially is going to be managed not by the bank itself but by a trustee. So the trustee will put those together and will create essentially a bundle of securities based on the original investment. The special purpose vehicle creates those securities, creates new securities, and then sells those in tranches or slices. Tranche is just the French word for slice. It makes it sound so much better. Here you can see an example of how a collateralized debt obligation would work. We have got the bank, which has had many bonds that it's financed, so perhaps 100 bonds, and the average yield for the entire portfolio of bonds is about 8%. They put all of these bonds in a package into the trust. The trust manager then will sell those in tranches. Now, the best tranche are going to be the lowest risk tranche, and perhaps that's tranche number 4. It's going to have a certain amount of risk, but the first risk is going to be borne by the first 3 in my group. We have tranche number 1. Tranche number 1 is going to take the very first hit. The very first company that goes broke, the very first bond that creates a loss, they're going to lose that one. And they're going to lose the next 4% as well. They're taking the big risk, and for that reason, they're going to get the highest yield from this particular instrument. Tranche number 2 takes the second 10% of loss. Tranche number 3 would take the third. Still pretty unlikely that you'd lose 25% of the portfolio value. But if they did, they would be the ones to bear it. Now, certainly these first 2 tranches are taking above average risk, so they're getting high yields. The next one's getting a pretty average yield. And whatever's left over, tranche number 4, the chances of losing 25% of value in this portfolio, just about 0. So they've essentially created a risk-free instrument, but they're getting a much better than risk-free return. And you can even combine this with other types of insurance. You can essentially buy insurance on this CDO so that you take no risk at all. By the way, an interesting bit of trivia, the lowest quality tranche, in this case tranche number 1, is sometimes described as the toxic waste tranche. So that as you have several different rounds of bond financing, quite often the lowest quality bonds remain in the portfolio, and the chances of default start to increase. So nobody really wants to take on that particular tranche. It becomes really high yielding because it takes that kind of a yield in order to sell it. A couple of other types of specialized financial instruments. In fact, one that I mentioned towards the beginning of this session, we talked about NKK, steelmaker, and dual currency bond. Essentially, a dual currency bond is a bond issued with coupons in one currency and principal redemption in another. Usually those currencies have very different yield levels, and essentially the valuation ensures the fair coupon rate is set between the 2 different levels of yield, the one for, say, the US dollar and one for the yen. It's attractive because you can borrow money in your preferred currency at a lower cost, then directly issuing bonds in that currency. And our final version, our final type of investment that we're covering today, although this is the bonds offer an almost infinite set of permutations, but these are some of the main categories. And then there's a currency option bond. That's like a dual currency, except that you have the option to be paid in 2 or even more currencies at the election of the bondholder. Essentially, it benefits the investor, who can obviously choose to be paid out in the better currency. The interest rate is set at issue. The interest rate that's set at issue is lower than the yields paid on a single currency bond in either currency, and it gives you long-term currency opportunities with very limited risks. Yeah. We've covered an awful lot in this session, and essentially we've had a look at how the bond market works. We've taken a look at how the international aspects are particularly important. As I said at the very beginning, we make no promises of covering all of the different things that you really do need to know about fixed income. We do have a separate course just for that. You can see from this particular table that if you look at a period of years with all of these different types of investments, for example, high yield European bonds, emerging market bonds, US high yield bonds, and so on, each of these different colors represents a different category. According to this table from Schroders, you can see that in no single year did one type of instrument offer the unique best solution. European high yield for many years were the best. US high yield for a couple of years were the best. Asset-backed securities like mortgage-backed securities might have also been best maybe in 2007 before the financial crisis. British bonds were sometimes at the top. None of these were particularly at the bottom all the time. So in order to be an all-round bond investor, you have to be able to understand all of these markets work, and perhaps to participate in many of these different bond markets. Thanks for your attention today, and I look forward to seeing you in the next session. Bye for now.